Imagine waking up on a Tuesday morning. You haven't even had your coffee yet, but you check your phone and see a notification. You've received a payment of $1,500. You didn't trade your time for it. You didn't make a deal with a boss. You didn't even have to be awake. That is the power of dividend investing. Most people think the stock market is just about buying low and selling high, hoping and praying the price goes up. But there is a secret side to the market where companies literally pay you just for owning a piece of them. It's like being a silent partner in some of the most successful businesses on the planet. In this video, I'm going to unveil exactly how you can start building this passive income stream from scratch. We're going to cover 1. What a dividend actually is and why companies pay them. 2. The magic of compounding that turns small change into a salary and more. 3. The 3-step strategy to picking your first dividend stock. 4. And the number 1 mistake beginners make that kills their portfolio before it starts. By the end of this video, you won't just understand dividends. You'll have a roadmap to your first payday. Now let's begin with Section 1. What is a dividend, really? Let's start with the basics. When a company makes a profit, they have a few choices. They can reinvest that money into new factories, they can sit on it, or, if they are stable and successful, they can share that profit with their shareholders. That share of the profit is your dividend. For example, let's look at the pizza analogy. Think of it like owning a pizza shop. You own 10% of the shop. At the end of the month, after the shop pays for flour, cheese, labor, and rent, there's $1,000 left over. Since you own 10%, the manager hands you $100. You still own your 10% of the shop, but now you have $100 in cash to spend however you like. Here are some key terms you need to know. Dividend yield. This is the percentage return you get annually. If a stock costs $100 and pays $5 a year in dividends, the yield is 5%. Payout ratio. This is the percentage of earnings a company pays out. If they earn $1 and pay 50 cents, the ratio is 50%. Pro tip. You want this below 60% usually so the company stays safe. Ex-dividend date. This is the cut-off date. You must own the stock before this date to get the next check. Why do we love dividends? Because they provide certainty. Stock prices go up and down like a roller coaster, but a solid dividend company like Coca-Cola or Pepsi has paid their shareholders every single year for decades, regardless of what the economy is doing. Section 2. The snowball effect, the math of wealth. Here is where most beginners quit because they don't see results in the first month. They buy 10 shares of a stock, get a check for $2 and think, this is pointless. I can't even buy a sandwich with this. But that $2 is the seed of your empire. The power of DRIP. DRIP stands for Dividend Reinvestment Plan. Instead of taking that $2 and spending it, you tell your brokerage to automatically buy $2 worth of more stock. Now, next quarter, you aren't getting paid on 10 shares. You're getting paid on 10.1 shares, then 11 shares, then 20, and so on. Now, let's look at the mathematical formula of fortune. In the world of finance, we use a specific formula to calculate the future value of an investment with compounding interest. FV equals P times open parenthesis, 1 plus R over N close parenthesis to the power of NT, where FV is the future value of your money. P is your initial investment, the principal. R is your annual interest rate, yield plus growth. N is the number of times interest is compounded per year. T is the number of years. Even if you start with just $100 a month, after 5 or 10 years, that snowball is no longer a hobby. It's a mountain of cash that can cover your mortgage, your groceries, and your vacations. This is how the wealthy stay wealthy. They don't work for money. Their money works for them. Section 3. How to pick your first stocks. You're probably wondering, which stocks should I buy? You shouldn't just pick the one with the highest yield. A company offering a 15% yield is often a yield trap. It's a sign the company is in trouble and the stock price is crashing. Instead, look for these 3 pillars. 1. The dividend aristocrats. These are the royalty of the stock market. These are companies in the S&P 500 that have not only paid a dividend but increased that dividend every single year for at least 25 consecutive years. Think companies like Procter & Gamble, Johnson & Johnson, or Target. 2. Dividend growth over high yield. I would rather own a company paying 2% that grows its dividend by 10% every year than a company paying 8% that never grows. Why? Because in 10 years, your yield on cost for the growth company will be massive. 3. Diversification, the ETF shortcut. If picking individual stocks feels scary, you can buy an ETF, exchange traded fund. This is a basket of hundreds of dividend stocks. SCHD, Schwab, U.S. Dividend Equity ETF, one of the gold standards for dividend growth. VYM, Vanguard High Dividend Yield, EETF, great for immediate cash flow. My advice? Start with an ETF to build your foundation, then add individual aristocrat stocks as you get more comfortable. Section 4. The roadmap to $1,000 per month. Let's get practical. How much do you actually need to retire or live off dividends? If your portfolio has an average yield of 4%, here is the math. To make $100 per month, $1,200 per year, you need $30,000 invested. To make $1,000 per month, $12,000 per year, you need $300,000 invested. I know, $300,000 sounds like a huge number, but remember the snowball. You aren't saving $300,000 out of your pocket. You are contributing a portion, and the dividends plus market growth are doing the heavy lifting for the rest. The most important step isn't the amount you invest, it's the date you start. Every day you wait is a day of compounding you can never get back. Conclusion and the next step. Dividend investing is a marathon, not a sprint. It's the boring way to get rich, but it's also the most proven way for ordinary people to build extraordinary wealth. If you're sitting there thinking, this sounds great, but I don't want to spend my life analyzing individual balance sheets and payout ratios, then I have something even better for you. While dividends are amazing for cash flow, there is a lazier way to reach that $1 million mark using a simple, hands-off approach that most millionaires use in secret. To see exactly how that works, you need to watch my next videos on the screen. I'll show you how to go about your investing journey and retire wealthy. Click and watch the videos now. I'll see you there. Add your questions in the comments section below. I will try my best to read and respond to your questions. Don't forget to like this video if you found it helpful and subscribe for more wealth building strategies.